Most traders think scalping is about being quick. It's actually about being bored. Let's talk about why scalping breaks people. Not theoretically, not in some abstract way. Actually breaks them, wipes accounts, creates emotional damage, makes people question if they should be trading at all. And here's the thing, nobody says out loud. Scalping isn't hard because the strategies are complicated. Most scalping strategies are dead simple. Buy support, sell resistance, trade momentum breaks, follow order flow. The actual setups? A teenager could learn them in a weekend. Scalping is hard because it puts your nervous system in a pressure chamber and cranks up the heat until something cracks. And whatever cracks first, that's the thing that was always going to blow up your account eventually. Scalping just makes it happen faster. Most people come to scalping for exactly the wrong reasons. They think it's exciting. They think it's where the action is. They see someone posting 50 trades a day on Twitter and think, yeah, that's what a real trader looks like. They want to be in the market, making decisions, feeling like something's happening. That's not trading. That's an adrenaline addiction with a brokerage account attached. The traders who actually survive scalping, they're the ones who find it boring. They sit there for an hour waiting for one specific setup. They take 2 trades and stop. They watch price action like they're watching paint dry, and they're completely fine with that. Because here's what scalping actually is. It's the trading equivalent of being a sniper, not a machine gunner. You wait. You wait some more. You wait until the conditions are so perfect that the trade is obvious. Then you execute, collect, and disappear. But that's not what most people do. They open the charts and immediately feel like they need to do something. Price is moving. Candles are forming. Opportunities are everywhere, right? Wrong. What looks like opportunity is usually just noise with a price tag attached. And this is where scalping becomes dangerous in a way that other trading styles don't. In swing trading, you put on a position and you have time to think, time to evaluate, time to realize you made a mistake and adjust. The market might take 3 days to prove you wrong. You can step away, get perspective, come back with fresh eyes. Scalping doesn't give you that. Scalping gives you 90 seconds, maybe less. You put on a position, and within 2 minutes, you know if it's working. If it's not, you're supposed to cut it immediately. No hesitation. No, let me see if it comes back. No, maybe it just needs a minute. But here's the problem. Your brain doesn't work that way. Your brain hates taking losses. It really hates it. And when you take a loss 60 seconds after entering a trade, your brain treats that like a personal attack. You were wrong. You messed up. You need to fix this. Except you don't need to fix anything. You just need to move on. This is the first place scalping breaks people. The speed at which losses happen makes them feel more personal. A swing trader loses on a trade, they can rationalize it. The market changed, news came out, conditions shifted. There's distance. There's narrative. A scalper loses on a trade, and there's no narrative. You were wrong 90 seconds ago. That's it. And your ego doesn't like that. So what happens? Revenge trading. Except nobody calls it revenge trading. They call it getting back in flow, or staying active, or capitalizing on momentum. It's the same thing. You're trading emotionally. You're trying to win back what you just lost, not because you see a setup, but because you feel a need. And here's where it gets worse. Scalping gives you infinite opportunities to make this mistake. Swing traders might get 5 or 6 good setups a week. That's 5 or 6 chances to mess up emotionally. Scalpers get dozens of setups a day. Every single one is an opportunity to overtrade, to revenge trade, to chase, to force something that isn't there. The market is always open. Price is always moving. You can always find a reason to take another trade. And that's the trap. Because in scalping, the game isn't how many trades can I take. The game is how many trades can I not take. The best scalpers have a lower trade frequency than you'd think. They're not sitting there hitting buttons every 2 minutes. They're sitting there saying no every 2 minutes. No, that's not my setup. No, the spread's too wide. No, volume's dropping off. No, I'm already up on the day. No, I just took a loss and I'm not clear-headed. No, 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 no. Saying no is the skill. Actually taking the trade, that's the easy part.
But let's talk about what happens when you don't say no. When you start overtrading. Overtrading and scalping doesn't look like overtrading in other styles. It's not obvious. You're not revenge trading with huge position sizes or breaking risk rules. You're just taking too many trades. Trades that kind of look like your setup, but aren't really. Trades where the conditions are 80% there instead of 100%. And because scalping has tight margins, those 80% trades kill you. Here's why. Scalping is a volume game. You make money on repetition. You have a setup that wins 55% or 60% of the time with a good risk-reward ratio, and you execute it cleanly over and over. The edge is small, but consistent. That edge disappears the moment you start taking trades that aren't actually your setup. Now you're winning 50% of the time instead of 60%. Now you're paying more in commissions and spread because you're overtrading. Now your win rate and risk reward are both slightly worse, and suddenly your P&L is flat or negative even though you're executing your strategy. Except you're not executing your strategy. You're executing something that looks like your strategy, but with all the edges filed off. And here's the really brutal part. You won't notice this happening in real time. You'll take a trade that feels right. It loses. Okay, whatever. That happens. You take another trade. Wins. Good. Another trade. Loses. Fine. Another trade. Small win. You're treading water, but you're active. You're engaged. You feel like you're doing something. By the end of the day, you're down. Not a lot. Just a little. Couple $100. Nothing dramatic. You can't point to one specific mistake. You didn't blow up. You just leaked. And that's how most scalpers die. Not in a fireball. In a slow leak, they don't notice until the tank's empty. Now let's talk about position sizing, because this is where scalping gets existential. Scalping has tiny profit targets. You're not trying to catch 5-point moves. You're trying to catch half a point. 20 ticks. 15 cents. It's small. Which means if you want to make meaningful money, you need to trade size. Real size. The kind of size that makes your heartbeat show up in the chart. And this is where the psychological trap really locks in. You start small. You're trading 10 shares, making $3 a trade. That's frustrating. You're doing everything right, but you're making lunch money. So you scale up to 50 shares, then 100, then 200. Now you're making real money on winners. $50, $100. Feels good, right? You finally feel like you're getting paid for this, till you take a loss. That loss is bigger now too, way bigger. And suddenly your heart rate's up, your palms are sweating. You feel the money moving in a way you didn't before. And that feeling? That's the beginning of the end. Because here's the thing about scalping. You cannot trade emotionally activated and survive. You just can't. Scalping requires you to make decisions in seconds. No hesitation. You see the setup. You execute. No overthinking. It works or it doesn't. You move on. But when you're emotionally activated, when you feel that adrenaline kick from the position size, you can't do that anymore. You hesitate. You second guess. You hold a loser too long because you don't want to take the pain. You exit a winner too early because you're scared of giving it back. Your execution falls apart. And in scalping, execution is everything. You can have the best strategy in the world, but if your execution is off by 2 seconds, you're losing money. This is why successful scalpers sound like robots when they talk about trading. I saw the setup. I took the trade. It hit my target. I exited. There's no story there. No drama, no emotional arc. Because they're not trading with emotion. They're trading with a checklist. Does this meet my criteria? Yes. Execute. No. Don't. Hit my exit. It hit my target. Exit. Done. That sounds simple. It's not. It's one of the hardest things you'll ever try to do consistently.
Here's another thing that breaks people. Fatigue. Scalping is exhausting. Genuinely, physically exhausting. You're staring at screens with complete focus for hours. Every price tick matters. You can't zone out. Every volume surge could be a signal. You can't half pay attention. You're fully locked in or you're losing money. And your brain can only do that for so long. Most people can maintain that level of focus for 90 minutes, maybe 2 hours if they're sharp. After that, performance degrades. You start missing setups. You start taking trades you shouldn't. Your execution gets sloppy. But people don't stop. They keep trading. They keep pushing. They think, I'm a trader. I should be able to do this all day. And then they wonder why they make money in the first hour and lose it in the third. The professionals? They trade for an hour, maybe 2. Then they're done. They walk away. They don't care if there are more setups. They don't care if the market's moving. They know their window of peak performance, and they don't trade outside it. Because trading tired is like trading drunk. Your reaction time slows. Your judgment gets fuzzy. You make mistakes you'd never make fresh. But in scalping, one mistake can erase 10 good trades. That's not an exaggeration. You can grind out small wins all morning, then hold one bad trade for 15 extra seconds and give it all back. Let's talk about what happens when you're in a drawdown. In swing trading, a drawdown means you're down on a position. You have time to manage it. You can adjust your stop. You can hedge. You can think. In scalping, a drawdown means you're down on the day, and your brain starts screaming at you to fix it. This is where people completely unravel. They start trading bigger size to make it back faster. They start taking marginal setups they'd normally skip. They start forcing trades because they need to get back to break even before the day ends. And that's how a small loss becomes a catastrophic loss. Because here's the reality. In scalping, some days you lose. That's not a flaw in your strategy. That's not a sign you did something wrong. It's just statistical reality. Your edge plays out over hundreds of trades, not over one day. But emotionally, ending the day, red feels like failure. So people keep trading. They keep pushing. They try to trade their way out of it. And you can't trade your way out of emotional drawdowns. You can only make them worse. The move is to just stop, take the small loss, come back tomorrow. But that requires accepting the loss. And most people can't do that. They need the win. They need to feel like they recovered. They need to end the day green. That need is what kills them. Here's something nobody talks about. Scalping reveals your relationship with control. Most people come to trading because they want control. They're tired of bosses, tired of systems they can't influence, tired of outcomes that don't match their effort. They want something where their decisions directly determine their results. Scalping gives you that. Every decision is yours. Every outcome is immediate. You have complete control over your execution. But here's the twist. Having complete control means you have nobody to blame. When a swing trade goes bad, you can blame the Fed. You can blame news. You can blame macro conditions. There's distance between your decision and the outcome. In scalping, there's no distance. You took the trade. It lost. That's it. You can't blame anything except your own judgment, your own execution, your own discipline. And for a lot of people, that's unbearable. They don't actually want that much control. They want the illusion of control with the safety of external factors to blame. Scalping strips that away. It's just you, the chart, and your decisions. And if you can't handle being solely responsible for every outcome, scalping will absolutely destroy you psychologically. Let's talk about something practical. Commissions and spread. In longer-term trading, commissions are basically irrelevant. You're making $5 or $10 or $50 moves. Who cares if you paid $1 in commissions? In scalping, commissions are everything. You're making 30-cent moves. If your commissions are 8 cents round trip, you just gave up 25% of your profit to your broker. And spread? That's worse. If you're scalping something with a wide spread, you're automatically starting every trade in the red. You buy at the ask, sell at the bid. That spread is a loss you have to overcome before you even make money. This is why most scalpers trade the same handful of instruments. They need tight spreads. They need high liquidity. They need markets where they can get in and out instantly without slippage. But people don't think about this. They try to scalp random penny stocks or low-volume futures contracts, and they can't figure out why they're losing money even when they're right about direction. It's because they're getting destroyed by friction costs. Scalping is a low-margin game. Every cost matters. Every basis point matters. If you're not optimizing for the tightest possible execution costs, you're fighting with one hand tied behind your back.
Here's a question. Why do people even want to scalp? Seriously. Why choose the most psychologically demanding, fastest-paced, highest-frequency style of trading? What's the appeal? For some people, it's legitimate. They have the temperament for it. They like the immediacy. They like knowing exactly where they stand within minutes. They like the clean feedback loop. But for most people, they think it's easier. They think shorter time frames mean faster profits. They think they can compound gains quicker. They think they'll figure it out faster because the feedback is immediate. That's backwards. The immediate feedback doesn't make it easier. It makes it harder because every mistake shows up instantly. Every emotional reaction gets reflected in your P&L immediately. There's no time to recover, no time to hide. Scalping is like learning to drive at 120 miles per hour. Every tiny error becomes massive. And when you crash, and you will crash, it happens faster and harder than it would have if you'd just been going the speed limit. Most traders would make more money and keep more sanity trading daily or 4-hour charts. But that's not exciting. That's not what trading looks like in movies. That doesn't feel like you're really doing it. So they scalp and they lose and they can't figure out why. Let's talk about the winners for a second. The people who actually make money scalping. They're weird. I don't mean that as an insult. They're psychologically unusual. They have a personality type that's rare. They don't get bored easily doing repetitive things. They don't need constant stimulation. They can watch the same setup for 4 hours and not feel like they're wasting time. They can take a loss and feel literally nothing. They can win and feel literally nothing. They have emotional flatlining as a skill. Most people can't do this. Most people need to feel something. They need the trade to mean something. They need the win to feel good and the loss to sting. That's normal human psychology. But normal human psychology is incompatible with scalping. Scalping requires you to treat wins and losses like identical data points. This one paid you. That one cost you. Neither matters more than the other. You're just collecting samples to see if your edge plays out over volume. If you can't achieve that level of detachment, you shouldn't scalp. Not because you're a bad trader, because your nervous system isn't built for it. Here's the part that's hard to hear. Most people fail at scalping, and it's not about effort. It's not about intelligence. It's not about capital or tools or education. It's about temperament. And you can't fix temperament. You can improve discipline. You can train emotional regulation. You can build better habits. But if your baseline personality is someone who needs excitement, who feels wins and losses intensely, who wants to be in the action, scalping is always going to be a fight against yourself, and you'll lose that fight. Not because you're weak, because you're trying to force yourself into a shape you're not built for. This is why the best advice for most people is, don't scalp. Not as a challenge, not as a test, not to prove you're serious about trading. Just don't.
Trade longer time frames. Give yourself room to breathe. Let your positions have time to work. Let your emotions settle between decisions. There's no honor in scalping. It's not more professional than swing trading. It's not more legitimate. It's just different. And for most people, it's worse. But let's say you're still interested. You think maybe you're one of the few who can do it. Fine. Here's the filter. Can you take 10 losses in a row and not change your position size, not change your strategy, not feel like you need to figure out what's wrong? Can you just take the 11th trade exactly like you took the first? If not, you can't scalp. Can you sit in front of your charts for 2 hours, see 12 potential setups, take 0 trades because none of them perfectly matched your criteria, and feel fine about that? Not frustrated, not like you wasted time, just fine. If not, you can't scalp. Can you be up on the day, hit your daily target, and stop trading even though the market's still moving and there are more setups forming? If not, you can't scalp. Those aren't trick questions. They're actual requirements. Here's what it comes down to. Scalping is the only trading style where the primary skill is doing nothing. And most people fail all three. Not taking trades, not executing quickly, not reading price action. Those matter, but they're secondary. The primary skill is restraint. It's saying no. It's sitting there with your hands in your lap while the market moves and not feeling like you're missing out. That's unnatural. Humans are wired to act, to engage, to do something. Sitting still while opportunities pass by feels wrong. It feels like you're not trying. But in scalping, sitting still is trying. Waiting is working. Saying no is the highest form of discipline. And if you can't embrace that, if you need to feel active, if you need to feel like you're participating, scalping will chew you up and spit you out. So here's the real conclusion. The thing nobody wants to say directly. Scalping isn't for you. Probably, statistically, almost certainly. Not because you're not good enough, because it doesn't match who you are. And that's fine. Actually, that's great. Knowing what you're not built for is just as valuable as knowing what you are. There are dozens of ways to trade. Swing trading, position trading, option strategies, longer-term trend following. You don't have to operate at maximum speed to make money. You don't have to put yourself in a psychological pressure cooker to prove you're a trader. Scalping is a tool. It's a very specific tool for a very specific type of person. If that's not you, put it down. Go find the tool that fits your hand. Because the worst thing you can do is spend 6 months or a year or 5 years trying to force yourself to scalp when every cell in your body is telling you it doesn't fit. That's not persistence. That's just self-harm with a chart attached. Most people shouldn't scalp. And there's nothing wrong with being most people. The money's not in scalping. The money's in trading the way that matches how your brain actually works. Figure that out, and you'll save yourself a lot of pain, a lot of time, and probably a lot of money too.